Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, I have to apologise because if you're watching this on YouTube, there is no visuals this week, and that's because I've been suffering with COVID, so I'm self-isolating at the moment, but normal service will resume next week where we will have the visuals for the YouTube channel. But in the meantime, let's get back to what's been going on in investment markets this week. And occasionally, very occasionally, you get something historic happens in markets on a particular day that will not only be remembered for the weeks and months ahead, but probably decades too. And that day was Monday, the 24th of January 2022. So if you recall, last week we were having weakness within equity markets, and the trend had been for there to be a sell-off in US equity markets, particularly tech stocks centered around those large US technology stocks. And it bled over into the other wider indices. And we saw some of that come across to other global equity markets, less so to the UK market. But following what was the worst week for global stock markets generally, then this Monday there was no respite. And in fact, the weakness that we'd seen the previous week accelerated on Monday. And the reason for such a strong acceleration was not one particular catalyst, but it was still that combination of various factors, including the potential for a Russian invasion of Ukraine, the impending US Federal Reserve monetary policy meeting that was due to occur on Wednesday. And in the UK, that decision is announced 7 p.m. UK time, so that's after the European markets have closed. And of course there was the slightly mixed start to corporate earnings seasons that I mentioned last week. There's also muddied the waters quite a bit, but it was really the fear over an aggressive monetary policy outlook from the Federal Reserve following the decision on Wednesday that the market was most concerned about. And that's because there are signs that in the US the economic expansion, the growth, might be starting to slow. So hiking interest rates aggressively into a potential slowing of the economic growth would obviously be pretty catastrophic, not only for the economy, but for the stock market as well. And so equity investors were quite spooked going into this week. And we'd already seen them start to price in up to 4 rate hikes from the US Federal Reserve in the previous week. Well, that pattern accelerated, and that repricing of bond and equity markets really accelerated on Monday. Now, to give you an example, by the start of Monday, so before markets had opened, the UK stock market was still in positive territory for the up between about 1 to 2%. But as you look more globally, then markets were already in a downtrend. And for example, if you looked at most Asian markets, they were down around 6%. We were down around 8% on the S&P 500, but the Nasdaq 100, so the tech-heavy Nasdaq, was down nearer 11 to 12% for the year to date. So what we saw on Monday was an acceleration of that trend. So at one point on Monday, the Nasdaq 100 was down 5% on the day. So you can see we had a sharp acceleration of that downtrend as investors capitulated. And if you look at the S&P 500, we were down about, at its worst point, 3.99%. So call it 4% on Monday. And we saw the S&P 500 officially enter a correction. So that's where it falls 10% from its recent high point. Now, if you go back to last week's show, I talked about a couple of key levels to keep an eye on the S&P 500, for example. So that was around 4,500. And if we broke through that, then things were likely to turn quite ugly before they could even get better. And that is exactly what happened. The market broke lower and we smashed through that 4,500 level, which then caused us to break even further down, go through the 200-day moving average for the S&P 500, which if you go below the 200-day moving average, that's typically quite a bearish signal. And we found some stability around about the 4,300 level. Now, what was interesting is that if you looked at the analysis that came out subsequently, so on Tuesday, analysing what happened in the sell-off on Monday, a lot of it was driven, or there was a large part of it, was caused by armchair investors, so retail investors who started to bail out en masse of their equity holdings, particularly in technology stocks. But the wider sell-off. Last week I mentioned that the tech tremor could turn out to be a wider earthquake for markets. That's exactly what did happen on Monday. Now, the negativity bled over into the FTSE 100. There was no escaping it. If you had equity holdings at the start of the week, the only place on Monday you would have been safe at the height of the selling was if you were in bonds, or if you were in gold or in cash. Otherwise, you would have been seeing a lot of red on the screen. And if you looked at Bitcoin, now Bitcoin has been in a steady decline since its November high. By Monday, it had fallen to below $33,000, and meaning it was 50% below its November high. And Bitcoin is now trading much more like, or more in line, I should say, with equity markets as more professional institutional investors are getting involved in that market. So when they go risk off and they sell out equities, they're also doing it in Bitcoin. So what's happening is Bitcoin is moving a lot in line with what's going on in equity markets and particularly technology stocks. Now, if you've been a regular listener to these shows and the Sunday podcast, you'll have heard about something called the Relative Strength Index, which is an indicator that I mentioned back in December, which gives a sign of whether a market is oversold or overbought. And it can be a good contrarian indicator for buying opportunities. So on that indicator, when you hit a level of 30 and you start to dip below, that can be a sign or contrarian indicator for those to start buying into the market that we could be overdue a rebound. Now, that isn't set in stone, because just because something is oversold, it can get even cheaper and become even more oversold. And we saw that actually, because the previous week on the Friday, the NASDAQ was the most oversold it had been since the pandemic crash. And yet on Monday, there we were, the market was continuing to fall. But interestingly, during the day on Monday, the market did in fact stage a rebound after all those investors who were incredibly emotional sold out. And the market rebounded, but the rebound was incredible. So we went from a 5% drop, for example, on the NASDAQ to finish up 0.6% on the day in positive territory. Similarly, I mentioned the minus 3.99% fall that the S&P 500 was enduring at the worst point during Monday. It recovered to finish plus 0.3% on Monday. Now that is such an incredible turnaround that the historians were looking at the books and trying to work out if we'd seen anything quite like it before. And in fact, we barely have. There's been very few instances where we've had such a turnaround in equity markets. 2 occasions in recent history have actually been during the financial crisis, so in October 2008. So that shows you that we are going to be talking about Monday and what occurred for a long time, because this is the sort of thing that occurs very rarely, and there'll be a lot of people who are involved in investing who have never seen such a bout of volatility in a single day during their investing careers. So it meant that the market rebounded, and actually from a technical standpoint, that rebound should have set up something that would be very bullish for the next day on Tuesday, as the market then started to think maybe the Fed would be more dovish, and there was the hope that it would be more dovish, perhaps in the face of the weakness that we'd seen in stock markets. After all, the Fed has been known to pivot and slightly be led by what's been going on in stock markets. And what we saw was that by Tuesday, the rebound didn't really gather any pace. In fact, the next day we finished slightly down on nearly all the major indices in the US. And it was a similar story around the globe, that markets were largely flat, or we had slight upticks in European equities. Come Wednesday, so that was yesterday as I make this show, it was all about what the Fed would do, and the markets were waiting for the announcement. And interestingly, what we saw was when the Fed announced its policy decision, we saw a big uptick, a relief rally in tech stocks. And they were up almost 3% on the day, in fact, just after the announcement. But then Jerome Powell, who's the chair of the US Federal Reserve, started talking, and that caused markets to then implode and deflate again. And we started to revisit the 4,300 levels that we saw on the S&P 500 earlier on in the week. So what Powell did was he was basically incredibly hawkish in his outlook and assessment of the US economy, meaning that he didn't even rule out the possibility that there could be a rate hike at every single meeting this year of the US Federal Reserve's committee that decides upon the path of monetary policy in the US. So that is more than just 3 or 4 rate hikes. We could be talking about 6 or 7. Of course, that was incredibly hawkish. We saw the positive mood in equity markets completely unwind in the US. Don't forget, European and Asian markets were closed at that point, and we saw it deflate, and we ended up finishing down on the day. Now, where we are today as I make this show, which is Thursday, is that equity markets are now looking for direction, and the lows of Monday haven't been hit again, but we are still bouncing around that level broadly on the S&P 500. Keep an eye on that 4,300 level. That will prove key, down to 4,250. I think if we break down below that, then this market could completely unravel. So the uptrend in US stocks is definitely under threat. Some people would actually say it's now already been broken. So that what happens in the coming days and weeks is going to be crucial. And now the US earnings season, of course, is still unfolding. And there have been some positives in there from Microsoft, for example, which did add to the positive sentiment. So that's still got to play out. We've still got some big tech names in the next week to release their earnings. And also we've got earnings still coming out in Europe. So right now, markets are in a fragile state. If you look at bond markets, the 10-year US Treasury was back up above 1.8% after Powell's hawkish assessment of the economy. And what the narrative will be in the coming days will be interesting. Will it be that they will start to say that actually there are signs that the US economy is on a strong footing and therefore cyclicals will start to rally again and pick up? Or will it be that the Fed is going to kill the recovery and therefore this bull market? That is going to pan out in the next couple of days. There is a potential for some serious moves either way, up or down in the market. We are in a very different place to where we were, say, 2 weeks ago. I think markets are much more fragile. And if you want to give some historical context to this, which I'll do a lot more for 80/20 investor members, the fact that I mentioned that the last time we saw such volatility in markets to such extreme levels that we've seen this week was during periods of extreme crisis in history. So, for example, the Great Financial Crisis, and it didn't signal necessarily the bottom of the market when that sell-off occurred. We had further weakness after that. So the question is now becoming, is that it? Is the market going to rebound in the next few weeks and recover? Or was it really a sign of what is to come for investment markets? Despite them being in the most bearish and oversold state that they have been since the pandemic low that we had in March 2020. So there's a lot going on in investment markets, and I have a feeling in the next couple of weeks I'm going to be talking about some quite wild moves in the lead up to the next Federal Reserve meeting. And don't forget, we've also got an interest rate meeting in the UK. So the Bank of England are going to be announcing their latest monetary policy decision next week, and the odds of a rate rise next week to 0.5%, up from the current 0.25%, have just increased in recent days. So that is going to be something that a lot of people are going to be talking about. So will that start to impact the UK stock market as well as what's going on in Westminster? Because at the moment, UK stocks still seem to be holding up well. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, Money to the Masses with a number 2. And of course, we're on TikTok, Instagram, Facebook, and don't forget to subscribe to our YouTube channel.